The following is paid programming. Welcome to Something More with Chris Boyd, certified financial planner practitioner and founder of Asset Management Resources, LLC, a registered investment advisor firm. We call it Something More because we like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients across the country, your host, J. Christopher Boyd.
Welcome to Something More with Chris Boyd, and I'm here with Jeff Perry, both of us of Asset Management Resources, and thanks for being with us on our podcast and radio program. We are really emphasizing the podcast more and more. Hope you're listening whenever it's good for you to do that. We're available on Spotify and Apple and pretty much wherever you might listen to your podcasts, you can find us. iHeartMedia, of course, has their podcast app as well. So in any case, we'd love to have you follow along. We post our podcasts generally on Fridays and Mondays, and we try to do 2 podcasts at a time. So in any case, so you can listen whenever is good for you. And thanks for being with us if you're listening on the radio as well, listening live. So to Saturdays when we broadcast anyway. Now, as far as Jeff, we want to talk a little bit about markets.
Well, it's good to talk about markets. Markets are up. Jeez,
we've had such a big run, haven't we? Yep. Just this quarter, I think, and you can look to last year and the challenges and headaches and frustrations that investors endured, both stocks and bonds. And now this year, we see somewhat of a different story that has really played out in both cases as well. Stocks rebounding, maybe not quite to the same highs that they've seen, but getting darn close.
Getting close, right, depending on the day.
Markets are up big for the year. And so, it moves from day to day. But, as we race to the end of the year, it looks pretty optimistic that we're going to have a nice end of the year. This quarter in particular, we've seen a lot of movement the last few months.
Well, ever since the Fed changed their tone, right? The Federal Reserve changed their interest rate tone. It was like there was it's like you're walking your dog and he's on that leash. You're holding him back, and the leash breaks. So you let him off the leash. There he goes, right?
Yeah. Well, there's some of that. I think also when you think about, we've seen the movement in the Treasury, the 10-year Treasury, the reversal in direction from October to, as this time we've seen like a 1% move or, thereabouts,
yes.
Which, that's essentially a 20% change in direction from in a percentage of what that rate implies. So, and not that prices have necessarily moved exactly that much, but we've seen a big change in that. And that, of course, as interest rates decline, it generally is favorable for prices of existing bonds. So both stocks and bonds have seen a nice move as we have moved into this quarter.
Once again, I attribute that to the Fed's change of tone on their interest rate posture for 2024. Seems like that changed everything.
It's this time of year, we often hear the term Santa Claus Rally. I think you had some thoughts about that.
Absolutely. And it started, I guess, quite a few years ago by a gentleman named Yale Hirsch, and he was the creator. If people have been investing for a long time, they may remember the Stock Traders Almanac. Started in the late 60s, and he coined a variety of terms, and one of them was certainly the
isms, right? A lot of isms, right? Yeah.
He's known for the Santa Claus Rally. He's known for the January barometer or the January effect. We can talk about all of these if you want. He's talked a lot about the impact of presidential election years. So he's looking at themes, I guess, in the market. And, do they generally have a favorable, negative effect when those things happen? Well, Santa Claus comes every year. Christmas comes every year, right?
Yeah.
So the idea is the week leading up to Christmas So right now, where we are, right, the 18th or the 17th through the 24th, up to Christmas, is when the alleged Santa Claus rally has an effect. And the idea is that everybody's happy. People are investing. People are looking at next year. People are positioning their portfolios for the end of the year.
Yeah.
And the market, according to the theory, is likely to go up. Now,
And there's a little more sentiment of optimism as you kind of
yeah,
look ahead, perhaps,
I think
generally.
so. So I went on to Investopedia, which has
While you're talking about this, before you continue on, I glanced over at my iPad while you're talking, and an article headline came up of referencing a Santa Claus rally.
I think people must be listening to us, Chris.
Yeah, I just thought that was so anyway.
Well, it's fun to talk about it because, we all like to believe in Santa Claus. So let's believe in the Santa Claus rally while we're at it.
There you go.
So Investopedia looked at the last 20 years of performance, and they're talking about the Standard & Poor's, S&P, the 500 largest, companies.
Cap weighted, all that, yep.
Yep. And they're looking at the week before Christmas, and they looked at a 20-year cycle, the last 20 years, and I know you're seated, so you won't be shocked by this, but there's minimal evidence of any discernible Santa Claus rally. The range in this 20-year span has been from a positive of 5.4% in 2021 to a negative of 10.7% in 2018 and 13. So that shows that kind of negative, but as the article goes on, there are 13 weeks that there was a positive return, 5 had a negative, and 2 had generally no change. So it's not something to get excited about every year, I guess, but it's certainly something that's fun to talk about, hope for, and
I think there's like I think a lot of these kind of truisms, they're not always true. It's not law, but there's something to them, right? That there's how they get their traction for people's capture people's imagination.
Yeah, yeah. So the January effect's the next one, Chris. And that's the idea that in the beginning of the year, early January, that people might front load their annual contributions to IRAs, individual retirement accounts, Roths,
more
or
money
otherwise,
going in. Yeah. Okay.
or that they've been thinking about new goals, or they've gone start to invest, right?
Yeah.
So that there's extra money
energy
coming into the
and
market.
Enthusiasm pushing the market higher. Yeah.
Right, and the year end earnings come out, fourth quarter earnings come out in early January typically, and so if it's a positive sentiment for earnings, that could be pushing markets up, or a positive outlook for a new year. So.
Well, I do think too, in a year when markets do well, that can cause some people to then say, "Hey, maybe I should move some of my cash, or get more money invested," or there can be that sort of lag effect where people start thinking, "Maybe I should too." And we do have a lot of money on the sidelines, or I say the sidelines. I think sometimes people are intentionally keeping that cash right now because they're feeling like I'm getting a decent rate, compared to what it's been in the past, and that creates some sense of I'm good with that, kind of mindset. But
if you could
in
get
the face of, go ahead.
If you could get 5% in a money market account or a CD at your local bank and take virtually no risk.
Yeah, in terms of market risk, it sounds appealing. Is it no risk? There's likely to be some inflation risk and some types of risk you don't necessarily associate with it. But yes, I agree. It sounds very appealing. It's just when we look at it long term, we can see that already there's signs that that's probably going to start to change direction, and by the end of next year, that'll probably be a little lower. And so it's enjoyable now, but will it retain that level of performance? And that might be the kind of thing where one would say, oh, maybe I'd be better served to kind of lock in some yields by having a little bit longer term associated with it. So maybe bonds would, or CDs that might be longer term in that scenario, would give me a better opportunity to retain that level of income that I appreciate, And so, again, it comes back to the idea of how do we invest? And generally, for most people, it's not all or nothing kind of investing. It's incremental, some of many things. On the one hand, something that's very stable and safe and provides liquidity, important to have. On the other hand, we want some investments that have maybe a modest degree of risk, but can get us maybe a little bit more than the rate that cash would produce. And then, for some people, you also want to have some money that's longer term in nature and might imply more volatility along the way, which usually, we think in terms of stock market volatility as a component of that. But as we've seen, last year markets went down. This year markets go up. It doesn't always happen that you recover your declines within 1 year, as we look like we will do over, from the beginning of 2021 to the end of the beginning of 2022 to the end of 2023. You look like you're pretty close to a recovery of, stock market movements, depending on where in the market you are, of course, can vary this, but just giving in generalities. So it's not necessarily comfortable for everyone to be fully invested in stock or anything, but you probably want some combination of these kinds of investments, because we know that, over time, stock investing or investments that involve risk, let's put it that way, and volatility risk is kind of the risk I'm focusing on, ultimately produce greater returns, given a little bit of perspective and time, and those returns can really be meaningful over a retirement or over time. So we don't necessarily want to be excluding those. It's just a question of to what extent we want to have some of that kind of risk in the mix, and to what extent we want to have cash and liquidity and stability, which can have appeal. And right now it's attractive because that yield is high, but it probably won't always be as high as it is right now. And might make sense to try to lock in some of that yield in some of your fixed income investments too. So it's not an all or nothing kind of thing. Anyway, I went down a rabbit hole there. Sorry.
No, but it's all very valid, and it also is, I think, worth noting that these decisions that people make to go on the sidelines into a money market, or take money away from the market because they're not feeling comfortable and going into a CD just to feel safe. The data on these decisions clearly show that most people make the wrong decisions at the wrong time.
Yeah.
How many times have you heard over your career, I'm going to get back into the market when everything's clear, or I'm going to get back into the market after it goes back up? I mean, while that sounds like it might be safer, if that was your position, say 2 months ago, that I'm going to get back in, and you haven't gotten back in the last couple of months,
how
you've
much
missed
of a double-digit move did you miss?
Yeah, you may have missed all of it, and then you get the euphoria of people when the market is at record highs, and scrolling across the news screens, the market reaches record high, and then people have FOMO, fear of missing out, and they jump back in, which maybe right before a correction. So all this, to me, and I'm a long-term investor, I'm not in favor of, I never advocate trading and for any of our clients, but if you're a long-term investor, at some level your return has to do with how much time you have in your investments, not trading in between your investments.
Yeah, it's it's somewhat basic in some respects, but it's entirely true about human behavior. And how many times have we seen this, Jeff, with clients' impulses, and to your point about people saying things like, well, I might get in when I see it's better. that's usually too late. You've missed the bulk of the move by the time you say, "Oh, I can see it's now it's back to that kind of thing."
Right.
And it's not to say it's too late that you can't be investing, but you've missed a lot of the move when you do that. And timing of the market is something that time and time and again has proven to be elusive to people. That you may get lucky on occasion, and you may be able to sidestep some risk and that sort of thing. But with any degree of consistency and being right on both sides of that coin,
Right.
getting out and getting back in, it's usually fraught with a lack of success.
Right.
So what would you say is one, just structure your portfolio so you don't have as much volatility. If you're anxious about volatility,
Mhm.
look to use the investments that are the portion of your portfolio that you think long term with. This is the part of the portfolio that I'm not likely to use for a long time.
Right.
I can be more tolerant of volatility. And it's not to say that you don't want changes in your portfolio. It's not to say that you just want to sit tight the entirety of the bumping back and forth. In our strategies, the way we do things with we call it active allocation, we do make changes. They're on the edges, but we're still invested in the market. It's not like we're getting out of stocks. What we might do is tailor where we put more emphasis in the market.
Right.
We've seen this quarter, as an example, our chief investment officer, Brian Regan, liked the idea of introducing more small company stocks because the valuations of those small companies were low. What's happened this quarter? Small cap has been on a tear. So that's been appealing. There's going to be other parts of the portfolio we've seen that they'd already had a good move, those large cap growth stocks. So we started scaling back on some of those stocks
Mhm.
because their valuations looked more extended. We've seen different parts of the market represent different opportunities and different risks. So it's not to say that you want to be entirely passive or anything. What it really is, though, big picture, being invested, because nobody's right all the time. You ultimately want to be invested, and you can't truly time that market the way you might want to.
Exactly. And I'm wondering what the effect will be. I have a theory on what the effect will be as these interest rates continue. They're already declined quite a bit, as you noted, but as they continue to decline into 2024 as predicted. So when you have that CD that you have, for 9 months or whatever, all the, most common terms were, around
Yeah,
5%, and that comes up and they're offering you 2.5%, or the money market account starts to go, dwindle down as it has already off the highs of yield. Investors will look to other alternatives. It's a normal behavior.
yeah,
And
yeah.
will that change of sentiment on those types of assets and those levels of yield, will that be supportive of the market in theory in 2024, with that money also looking to get back into a more favorable return posture?
Yeah, I don't know. Started
Yeah.
thinking about where I was going next. Sorry, I was going to just jump to something else, but that's a good point. I got distracted. So one of the things I wanted to mention was we saw an article from Barron's Magazine recently about outlook for 2024, and one of the things that I think when we look to next year that I think we continually hear people talk about is, what's the impact that the election is going to have, and is that something that affects markets? And the one of the sentiments that came across in this article was the idea that we don't know what the Fed will do. To your point, how quickly will the Fed look to move interest rates down? I think we have the expectation that the Fed will reduce rates, but when? How quickly? When will they do it in a way that's not perceived to be interfering with election outcomes, that kind of thing. And I think there's some expectation that we might see something similar to this year, next year, which is the end of the year might be when you see more market movement after election results are known. There's more just certainty of here's where we're at, and markets can get a sense of, okay, we know what we're dealing with. Let's look ahead and some of that. Whereas in the meantime, you may have some of the uncertainties weighing on things. Who knows what the world events will be?
We certainly know that can change in a heartbeat, right?
Yeah. And so in the
Things we
meantime,
don't know.
it's a look at how will earnings move, which I think you said, as we started thinking about, in January, what will earnings start to be? And we have seen earnings remain relatively strong. And yet the economy is slowing, right? But not recession yet, is that
Not even close. Not even
so
close.
so will earnings continue to be strong? Will that drive, when we talk about, for example, forward-looking PE ratios, market valuations, this expectation of where are we in this? Will that drive earnings higher, expectations higher? Will that permit the idea of this idea that stocks should be valued higher than they are? Whereas right now they seem a little bit lofty, not outrageously so, but ahead of a long-term average. What was it, 18, 19 times earnings, something like that?
19 right now, yeah.
And will that cause some pullback, or will earnings enhance and therefore justify that? And what will happen with the markets? It seemed like in this article, a lot of the commentary was not really expecting a drastically higher market from where we are today. In some cases,
the range.
lower.
Yeah, the range was from 4,500 on the S&P to 5,400, and we're at 4,700 roughly this week.
Yeah, and so you have a few people kind of. There was like one standout. Yardini had a way up kind of expectation, but so it's hard to know what will happen. But I think generally that's encouraging that there's somewhat optimism in that, at least in that instance. But I just think it'll be an interesting year as we look ahead.
Well, let me go back to Yale Hirsch for a second. The presidential election effect. So the data on that is positive. 3 out of 4 times, 75%. The market is up during an election year, and that was in the Barron's article, I think. I've read so much this morning.
Yeah.
And the average return, I think, was 7.5% in a presidential year. So.
Interesting. Yeah. So we'll see. And I think, I bet there's a ton of data about whether it makes a difference, how the outcome of the election for a pop in the market or not. I think it depends on when you measure that. Is it from the election or the inauguration? That you get very different numbers sometimes.
Yep. I'm not even sure who the candidates are going to be. I'm not even sure if the 2 leading candidates are going to be alive or in jail, or I think there's some added volatility predicted because of the uncertainty of the presidential election as well. I just think that has to be factored in, because this is not a normal. I don't know if we ever had a normal election, but you know what I'm saying. This one is
it's just an oddity.
One for the history books. How this plays out.
So with that, we should probably wrap up for this segment. Jeff, thanks for being with me. Lots to think about as we look toward year end and beginning of a new year before you know it. Hey, everybody, until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's financial planning, portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at amrfinancial.com or call us toll free at 866-771-8901 or send us your questions to radio@amrfinancial.com.
You're listening to Something More with Chris Boyd, Financial Talk Show.
Asset Management Resources LLC and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.